We're moving into a system that's all about commodities and transparency.
Yeah.
Blockchain, gold, we're moving there. So maybe Trump is ahead of the curve here and is onshoring our gold before it gets siphoned off across the globe because we were so stupid in the West for all of these years to suppress gold and silver, playing right into the hands of the countries that are saying, thank you, we'll stand for delivery. And that's what's different than anything I've ever seen. These countries are sophisticated, motivated, coordinated, and wealthy. Give me the damn metal. I don't
Right.
want more paper. And when you get to that point where it becomes more obvious, then there's a run. I know we said gold, but I'm just as bullish and probably more bullish on potential.
The official U.S. gold reserve currently stands at 260 million ounces, valued at only $11 billion on the Federal Reserve's balance sheet. However, the actual market value of this gold is estimated to be around $770 billion. There has been growing speculation that the value of this gold reserve may be repriced to reflect its true market value. If this revaluation were to occur, the immediate effect would be an increase of $750 billion in the Treasury General Account, TGA, the federal government's demand account at the Fed. Essentially, this would mean the government could spend $750 billion, leading to a direct increase in the U.S. money supply. This monetary boost would likely provide a short-term economic lift, potentially delaying a recession and offering some support to the stock market. The increase in the money supply would flow into the commercial banking system, boosting bank reserves. However, while this would provide immediate economic benefits, it would not necessarily benefit gold. If anything, gold could be negatively affected unless it becomes a pro-cyclical asset, which is unlikely under such conditions. In the short term, such a monetary injection could temporarily boost the economy, helping to delay a potential recession and offering support to the stock market. The increase in the money supply would result in higher inflation, which would, in turn, lead to higher long-term interest rates. This could prompt the Federal Reserve to extend its quantitative tightening (QT) measures to absorb the additional liquidity. Politically, it would make more sense for the revaluation to occur in the final year of a presidential term rather than in the early stages. If the revaluation occurs, Andy Schectman suggests it would likely be part of a stimulus package during a future recession or in the next presidential election, providing a short-term economic boost when it is most needed. We present the clips of Andy's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Ivan, I don't know what all of this means, but it means something substantial. I mean, since November, the United States has become a net importer of gold instead of a net exporter. November, interesting time frame. We've imported just from London alone north of 13 million ounces of gold, and that's just London. That doesn't take into account other places like Switzerland or Singapore or other venues. We've seen the largest delivery ever in the history of the COMEX market for the February contract of just under 6 million ounces of gold, surpassing the next largest, which was during the pandemic in 2020, QE forever, 1.2 million ounces of gold.
Wow.
I mean, so you're talking massive deliveries. The next largest in the history of the COMEX was 4.8 million or somewhere around that number, 4.7. So this is huge. We're seeing JP Morgan deposit 4 billion worth of gold into the COMEX in February, and Blythe Masters said that that's for a client. When you talk about, they don't own it for themselves. They said we only do business for clients. So, what kind of client has $4 billion to put into gold and have it delivered into COMEX? We're seeing the metal coming from London environment where T is the trade day. Let's say Monday or exchange is what I'm trying to say. T is the trade day. Monday +1, Tuesday, Wednesday. In theory, your metal should be available. It's now T plus 6 to 8 weeks, and they say it's because of lack of manpower and of trucks.
Wow.
In the lease rates spike, which is always a troubling sign as well. Now they've normalized a little bit, but they definitely spiked. We're seeing the spread between London and New York. You buy in London, sell in New York. At one point, it was $80 an ounce. It's come back a bit, but this signals massive strain in the market. And whatever we're seeing, all I can tell you, whatever we're seeing is way off the charts, Ivan. It's an anomaly in terms of anything I've ever seen. in my career, and it seems to be American centric. It seems to be we're reshoring the gold. Now, what are they going to do with it? Are they going to follow Judy Shelton's lead and collar it to 50-year treasuries, redeemable in gold? She told me Trump will issue them July 4th, 2026, the 250th year anniversary, that they've discussed it at length.
Wow.
Is it something else? Is it playing that spread between London and New York, but the shipping costs alone mitigate that profit? Is it backing the naked contracts that, the massive naked contracts and the rehypothecation, or the commercial banks wising up, bringing that gold home? It's not, certainly just not the Trump tariffs, whatever it is, and I'm not sure exactly what it is. Maybe it's the Basel III regulations where you have to have physical metal instead of paper derivatives. All of these things are in play. Or is it something much bigger? Are they going to revalue gold? After all, it's held in the gold revaluation account at 42.22 an ounce. That's the value of it. And that's the name of it on every central bank balance sheet. Get that. The gold revaluation account. You can't even make it up.
Wow.
In Europe, it's at $35 an ounce. But after Nixon closed the gold window in 71, he revalued it from 35 to 38 in 72, and from 38 to 42.22 in 73, where it stood forever. So on the United States balance sheet, if the gold is really there, they're going to go look. It's valued at 42.22. Just marking it to market would add 700-800 billion to the Treasury coffers. What if they go much further than that? And it's happened. It's not without precedent. I don't know. It's interesting that central banks hold gold in what's called the gold revaluation account. That's in essence what Roosevelt did when he confiscated gold at $20.67 or whatnot for every $20 gold coin. People were like, yeah, we're getting a premium. It's fantastic. A dozen eggs are a nickel back then, 67 cents. I think it was 2067. That's a lot of money. Well, then he revalued gold, or devalued the dollar by 40%, putting gold at 35, just like that. And so it's happened.
Right.
And then you have the head of the Dutch National Bank and members of the Bundesbank for 2-3 years screaming, let's revalue the gold, held in the gold revaluation account to offset our liabilities on our balance sheet. And even Cynthia Lummis, the senator from Wyoming, let's revalue gold, she says. Let's revalue gold so that we have the ability to buy Bitcoin for the strategic Bitcoin account. So I don't know, man. All I can tell you is this, that whatever is going on is a wicked anomaly. It's way outside the realm of what normally is. And I don't know. I guess only time will tell, but interesting times for gold no matter what.
The increasing demand for gold by countries worldwide, especially in light of potential audits revealing discrepancies in the gold reserves, raises significant questions. If countries began demanding their gold, and it turned out that the reserves were not as large as claimed, the implications would be far-reaching. There is growing concern that the actual gold supply may not be there, particularly with many nations, such as India, repatriating their gold from foreign vaults like the Bank of England and the New York Fed. Over the past few years, countries have been pulling back their gold, signifying a shift towards a more cautious and self-reliant approach to their reserves. This is particularly evident with central banks no longer net buying U.S. treasuries, but instead investing in gold, which has outperformed traditional assets. Andy Schectman points out that this is not a coincidence. It's a strategic move as these countries recognize the value of hard assets in a world increasingly moving towards commodities-backed financial systems. Unlike gold, silver's price has been suppressed for years, largely by the military-industrial complex. Silver's asymmetric risk-reward profile offers the best upside with a relatively low downside. Given the recent surge in demand and the increasing number of silver contracts being delivered, Andy suggests that silver's potential is immense, even more so than gold, given the market conditions. Therefore, the precious metals market is on the cusp of significant shifts, and understanding the dynamics of gold and silver is essential in navigating this changing landscape.
Since several years now, for several years, we have not seen any central banks net buy bonds. More have sold than bought. They're all buying gold. And so this is a situation where I don't think we've seen anything yet. And maybe it's a realization by Trump that this is a game, as Zoltan Pozar says, he who has the gold makes the rules. He said Bretton Woods 3, we're moving into a system that's all about commodities and transparency. Blockchain, gold, we're moving there. So maybe Trump is ahead of the curve here and is onshoring our gold before it gets siphoned off across the globe, because we were so stupid in the West for all of these years to suppress gold and silver, playing right into the hands of the countries that are saying, thank you, we'll stand for delivery. And that's what's different than anything I've ever seen. These countries are sophisticated, motivated, coordinated, and wealthy. Give me the damn metal. I don't want more paper. What we see now is certainly intriguing and outside the norm. But when you start to see a run on these institutions, force majeure on the COMEX, God only knows what on the LBMA. I think it could get interesting, and maybe it's just tariffs. Don't know, but these are the times we live in. Very fluid, very interesting, certainly worth keeping your eye on the ball. Because we're talking about gold, look, many of the same things are happening with silver too, Ivan, and maybe in spades. To me, I'll just say this regarding silver, and I know that's what your listeners predominantly own and think about and research. Only the duality or plurality, that's a word, in demand between military and green and digital and monetary.
Yeah.
Set that's depleting in nature, increasing in demand, been held down in price forever, probably by the military industrial complex so they can make high-tech weapons. But whatever it is, I don't know that there's an asset that offers the upside that silver does with the mitigated downside. And we've seen, I don't know, 14, 15 million ounces of silver stand for delivery recently also, if not more. I haven't seen what happened here just recently, the recent commitment of traders. But there's a lot of silver coming in to the U.S. as well. It's not just gold that's being imported. So as one goes, so too does the other. They have about a 90% correlation through all of history. Maybe not in perfect unison, but one won't go to the moon without the other. So I know we said gold, but I'm just as bullish and probably more bullish on potential on silver.
The current macroeconomic environment is creating the perfect storm for gold, positioning the precious metal for its strongest first quarter ever. After setting 39 record highs in 2024, matching the 2011 global financial crisis peak, gold has continued its upward momentum in 2025, hitting 14 new record highs. Key factors driving this rally include President Trump's aggressive tariffs, which threaten to ignite trade wars and global uncertainty, and central banks globally accumulating gold at record rates to diversify away from the US dollar. In addition, the US is leading the charge in gobbling up vast amounts of physical gold, draining commercial vaults in London, Switzerland, and Singapore, and fueling concerns that this demand could lead to a shortage and drive prices higher. The deglobalization movement, with its protectionist policies and trade wars, has also contributed to the surge in gold demand as nations prioritize their own interests in an increasingly fragmented global economy. Share your thoughts on Andy's analysis in the comment section below. If you find this video informative, don't forget to support your finance log team and turn on notifications to stay informed about our latest videos. See you in the next video.